Yes, folks, we're back with another video. I have a video on this channel where I've covered my adaptation of ICT's silver bullet. I made a few changes to improve the win rate, and I made it sort of a little more simple with regards to eliminating, the ambiguity associated with whether we are going to target the buy side or the sell side liquidity. But still, there is some confusion there as to, when we're within the time window, we found a fair value gap or there is a break of structure. How do we know whether we are going to aim for the buy side liquidity or the sell side liquidity? And so, using this new method, which I call the silver bullet balanced price range strategy, we use an additional indicator to improve the win rate drastically from somewhere around 60% to around 80% win rate. This is in my personal backtesting. I'm going to run you through sort of what the balanced price range is, how the silver bullet BPR method works, sort of, do a quick explanation over here. I'll show you two examples and you can take this information and run with it. I'd say do 2 months worth of backtesting, sort of backtesting on 2 months worth of data, and then you should be ready to go. I used exactly this strategy to pass my funded account challenge. So it's pretty simple. Now looking over here, standard silver bullet hours, we're looking to trade this strategy within. This is London time, by the way, 8 to 9 a.m., 3 to 4 p.m., 7 to 8 p.m. 8 to 9 a.m. is the London session, London Open. 3 to 4 p.m. is the New York AM, and 7 to 8 p.m. is the New York PM. So what we're doing is within our time windows, we are looking for the first fair value gap to align with an existing balanced price range region. And we'll call this region the BPR FVG, right? We're going to get to explaining what this is. Both the FVG, so both the fair value gap and the balanced price range, must be bullish or bearish. So they both must have the same nature or both must be following the same trend. Again, this is all going to make sense when I show you the examples. On this trade, we are targeting 1.5 to 2 RR, so nothing crazy. We're keeping it very simple, very modest with our risk reward. So 1.5 is a great trade. 2, in my opinion, is sort of the best case for this because I personally like to take profits and move on to the next trade. I like to secure my profits. I don't really aim for 3, 4, 5 RR. I don't aim for those crazy trades. I like to keep things simple. And this setup only works for these 4 pairs as per my backtesting. Don't try this with other pairs and then complain to me that the setup doesn't work. I've only used it for Euro USD, GBP USD, the Nasdaq, and the S&P 500. Personally, I prefer to use it with just these first two. These are my preference. These 2 pairs are my preference. If you're feeling a bit lucky, you could also use it on the Nasdaq and the S&P, but the win rates are best with Euro USD, GBP USD. So, how does this strategy work? You'll often see that we have a series of candles going down, as you can see here. So a bearish series of candles, and then a bullish series of candles. Now, what we often obtain is this thing here called a balanced price range. And a balanced price range is essentially, so if I move this box over here, is essentially an overlap between 2 fair value gaps that are consecutive. So we've got a fair value gap over here, and then we've got another fair value gap over here. So there is 2 consecutive fair value gaps that overlap, and we're showing the second fair value gap using this green box over here. And this region of overlap is called the balanced price range. So this region over here, which I will make green, is our fair value gap. Oh, no. Yeah. So this is our fair value gap. This red rectangle over here is our balanced price range. So we have a balanced price range and we have an alignment with a fair value gap. They are both bullish, and so this is our confluence for entering the trade. So you can see over in here, fair value gap and the balanced price range are in alignment. We look for yellow and green or blue and red. And what that means is the indicator that we use to look for balanced price ranges is this one over here. And what this indicator does is, for a bearish balanced price range, it will show it as red. And for a bullish balanced price range, it will show it as green. On the other hand, the indicator that we use for fair value gaps within the silver bullet hours is this indicator over here. So save the name, search for it on TradingView, and add it to your indicators. And this indicator over here, for a bullish fair value gap, will show a yellow color, and for a bearish fair value gap, will show a blue color. So if we've got a yellow fair value gap overlapping with a green balanced price range, then we can take the trade because they are both bullish. On the other hand, if we have a bearish balanced price range, which is red, overlapping with a bearish fair value gap, which is blue, then we have a bearish alignment, then we can also take the trade. So you're looking for yellow and green or blue and red to overlap. That confluence is our entry. We'll now do sort of 2 examples. I'll show you all of this in practice. Everything's going to make sense, super simple, and you're going to be pretty much ready to take your funded challenges. All right, so this is our first example, Euro USD. This was the trade I took this morning. So this is the silver bullet hour for the London session. I'm looking for a bearish fair value gap that overlaps with a bearish balanced price range, or a bullish fair value gap that overlaps with a bullish balanced price range. So candle by candle, this was exactly how I took the trade. I can see here that I have a bullish fair value gap, but I'm looking for the overlap. So like I said here, I'm looking for yellow and green or blue and red. And I can only enter off either of these overlaps. So until I see that, there is no trade. Now, we've got a red, which means a bearish balance price range. And this is a bullish fair value gap. So we can't take this trade because they're not the same nature. But then we can see straight away that we now have an overlap of a bearish fair value gap, the blue, and a bearish balance price range, the red. And so we can now enter a short position off this bearish fair value gap. So we can take the short position over here with a risk to reward of 2 to 1. So I'll set my stop loss just over here. Risk reward of 2 to 1. So just about here. We can bring this down slightly. And that is our trade. And we'd actually, for a sniper entry, we'd look to enter over here. So just below the fair value gap, because oftentimes we don't tap into the fair value gap perfectly. We'll now adjust the stop loss to allow for 2 RR, and we are now ready to take the trade. Now let's see what happens. So let's see if we get tapped into the trade. Okay, we are now in the trade. We've been tapped into the trade. And let's see what price action goes now. Perfect. And that is take profit hit. So we tapped into our bearish BPR FVG. So this right here is what I will call BPR FVG bearish. So this right here is our BPR FVG bearish. 2 to 1 risk reward ratio. We tapped in perfectly, sniper entry, and take profit. Short trade, perfect. This is the perfect case study. And yeah, we'll now go on to the next example. Hopefully this makes sense. All right, so this is the second example. This is a trade I took yesterday during New York AM, silver bullet hour. So I've marked out, 3 p.m. to 4 p.m. Again, we are looking for a bullish balanced price range to overlap with a bullish fair value gap within the window. or vice versa. So a bearish balanced price range to overlap with a bearish fair value gap within the hour. Super simple. We're going to do candle by candle. We're going to see what happens, and I'll show you exactly how I took this trade. So we can see that a bullish balanced price range has now formed, and carries on into our silver bullet hour. We'll now be looking for a bullish fair value gap to overlap with this, and that'll be our signal to go long. And immediately, boom, we see that a bullish fair value gap overlaps with a bullish balanced price range, and so we could go long straight away. No need to wait. You could go for a sniper entry off the fair value gap exactly, but in my case, I think the confluence is quite strong. And so 2-to-1 risk reward, we'll set our stop loss just here, around, what is this? Around 12 pips. And 2-to-1 RR. So our TP just over here. And let's see what happens. We'll bring this over here. Immediately we're tapped into the trade. And bam, take profit hit. So if you'd waited to enter the trade directly off the fair value gap, more often than not, you're going to miss out on the trade. And so I suggest you don't look for sniper entries where you enter directly off the fair value gap. And ICT calls that the OTE, the optimal trade entry. Oftentimes, I'll take the trade or I'll set my entry to the trade just after the fair value gap to ensure I don't miss out on the trade. Because it's not always you're going to get the sniper entry. And we've hit the take profit. And again, hopefully sort of this example cleared up how the strategy works. Please like, subscribe. I've literally backtested this exact strategy. So the overlap of the BPL with the FVG on around 3 months of data for Euro USD, GBP USD, the Nasdaq, and S&P 500. My win rate, I can't lie, has been around 75%. So it's super profitable, really easy to execute. You don't need to analyze the markets. You don't need to look for liquidity. You don't need to look at the sort of market bias and switch between time frames. Stick to the 5-minute time frame. Set up these two indicators, back test it, and then you're ready to go. It's simple. Again, please like, subscribe, all that. Leave any questions in the comments, and I'll be putting out another video in 2 days or so. So I will see you lot then. Take care. Stay safe. Peace.